Thank you, everybody, for joining the 2024 webinar. We're going to go through some stocks, the economic backdrop for the U.S., some international, and we're going to review what we did last quarter in October. All right. So first and foremost, it's always nice just to have a little bit of disclosure, right? This is not investment advice. Please, pretty please, go get a financial advisor. Do your own research. These are my opinions. I kind of give you what I think and what I take, but don't make investment advice based on me. Do your own research and seek a professional investment advisor. You can read the full disclosure at my website. So I always like to start with a little bit of background. We have a lot of new people in the cash flow club and a lot of new people in this webinar. I've been working in finance for 20 years. Currently, I run companies for private equity companies. I'm the CFO for their portfolio companies, and I help them for really different model than what we do here. We use a tremendous amount of leverage in private equity to really execute on that market multiple arbitrage. That's what I talk about with the trifecta. One of the three is the market multiple arbitrage. That expansion of market multiple, that is essentially entirely all the private equity model. They use a tremendous amount of debt, so they don't have to put up much equity. They wait for that expansion and multiple, and that's what I try to help get them to accomplish. Been a part of an IPO process, took a company public in 2015. That's a long time ago. Wild process. Credit Suisse was the underwriter. Morgan Stanley was joint book runner, and Goldman Sachs was kind of in there with their high net worth clients. It was a lot of fun, but I learned a tremendous amount of kind of the chaos that goes on with analysts forecasting stocks. And I always thought that it was kind of a racket, kind of the model that they're willing to put forward to investors. So starting this club, I wanted to show everybody exactly how I arrived at the number, and you can judge if you think the growth is too high, too low. You can make those changes for yourself, but at least it's transparent how it arrived. So that's kind of me. Let's dive into the presentation and figure out where are we. So are we on target for inflation? Nice, from Maine, love it. Are we on target for inflation or not? It looks like we are. And when I took this clip here from one of the governors, Chris Waller, he's got a couple comments in his speech in January 16th. He said, "I believe policy is set properly. It is restrictive and should continue to put downward pressure on demand to allow us to continue to see moderate inflation readings. So, as I said, I believe we're on the right track to achieve 2% inflation." And definitely this chart looks like that. And I've covered in the past how I think the Fed does, or at least the reporting boards do tend to manipulate the metrics, the benchmarks they use. They use a kind of adjusted rent index. They love to exclude oil and food, which everybody has to use. So I think they do manipulate it a little bit, but it does seem like inflation is coming down. Whether it's 3.3 or 3.5, it's moving down in the general direction. And then he continued. He said, as of today, the data has come in even better. Real gross domestic product is expected to have grown between 1% and 2% in the fourth quarter. Unemployment is still below 4%. 4% is what they consider full employment. And core personal consumption expenditure inflation has been running close to 2% for the last 6 months. As a macroeconomist, this is almost as good as it gets. So the Fed is seeing tremendously positive data, and they've said that they're going to be data dependent. So if the economy is performing, or the inflation's coming down, would they cut rates? And I've been surprised at how well the economy has handled the current interest rate environment. And in fact, when you look at unemployment is still very, very low, 3.7% at the rate. Now, the Fed's mandate is two things: stable pricing and full employment. We are still at full employment, so I would not expect the Fed to really start cutting rates if the economy is doing really well and unemployment is still at full employment. There's no reason to lower rates and to boost the economy. I think everybody that I've read has been watching this number in particular, and they're waiting for it to go up. And when there's a spike, then the Fed will begin cutting rates. In January, this number bottomed at 3.4% of unemployment. It's since in the last 12 months moved up to 3.7. Does that mean it's going to keep going? I don't know. It's going to flatline here. Who knows? We are seeing more unemployment or layoff notices for some of the big corporations this quarter. I think people are using these tougher economic times to kind of bundle up all the changes they would like to make, kind of push it out the door and say, hey, we're adjusting with everybody else. So we might see that number tick up. And if it does, then I would expect the Fed to cut rates. But if it remains full employment and the economy is doing well, why would they cut? So an interesting thing to consider. When we look at what the market is expecting, and the reason we had a tremendous rally in December is the market as a whole assumes rate cuts are coming. And I think this is where you get to that divergence of thinking. We need the economy to come down and unemployment to spike for the Fed to cut rates. So it's like almost good news is bad news, or bad news is good news. If the economy starts to come down and retard or go into recession, the market's happy because they think they're going to cut rates and money's become cheap again. That's what they're anticipating. So any bad economic news that comes out, the market seems to react favorably to. But this is the forecast of when they think rates will come down. So sometime at the end of 2024, they think they're going to be from 5.5% to 4.5%. And by the end of 2025, they'll be at 3.5%. But notice it's not zero. And that's still higher than it was in 2018. That's still going to be very restrictive to highly levered investments. You're still going to have banks who made loans that are on their books at 0%. They're still going to be upside down. So the regime of quite literally negative interest rates is over. The bond bull market that's gone on for the last 30 years, I think, is over. And money has a cost now. You can see it bottomed here. This is the 30-year Treasury. There's the yield on the 30-year Treasury bottomed at 0.69%. So had you bought a 30-year Treasury, you'd be making 0.7% interest annually for 30 years on that money. Fast forward even 2 years, we're now at 4.2%, dramatically outside of the trend line. I think that's what that cost of money, that change, is causing assets to have to reprice. The longer this stays up here, the more difficult it is for businesses to maintain valuations that are dependent on cheap money, such as the real estate market. Like the commercial real estate market is having major issues, and everyone's hoping that rates come down and that will bring down the losses. The longer this stays up there, the harder it is for companies to justify the valuations that they have on the books for those loans, and the more likely it is that one of their bonds will mature. They'll have to go to market to raise new capital. The market will force them to market their own assets, and there will be a loss. That's where you get this unrealized loss that's sitting on the bank's balance sheets that everyone talks about, becoming a realized loss when they're forced to go raise capital, and the capital providers will not provide them money unless they adjust their books. So then let's take a look at the 2-year Treasury versus the Fed funds rate. The 2 years obviously up, but most recently the 2 year has been coming down here, and it's interesting that this little drop, it generally precedes the pulling down of the Fed funds rate. You can see here the blue line started coming down first, and then the red line. Same thing over here. We've got the blue line dropping slightly before the red. Same thing over here. So it's the pattern has typically been, there's a spike in unemployment. The market sees the movement in unemployment faster than the Fed can react with their meeting timing. Yields come down as people think that we're coming into a recession, and then the Fed follows. So the thinking here at least when I watched the double line presentation, which you guys should all go and watch. Jeff Gunlatch is a brilliant bond trader and investor. They're expecting unemployment to spike here in the next quarter or so. So then let's just talk a little bit about where we are, kind of the state of the U.S., kind of the underlying backdrop of what we're, the market landscape in which we're investing in. And I always think this is a really interesting chart. This is the debt, it's leverage. So it's relative to our GDP. So it's total US debt divided by the GDP. You get a ratio. In 1980, that ratio was 31%, very under levered. 30% of the economy was levered. Over the last 40 years, the US, Congress, various presidents, everybody has continued to increase spending, which is stimulative to the economy, financed by lower and lower interest rates over this period of time, all the way to now we sit at 120% of GDP. We have leverage of 120% GDP. So we're approaching $30 trillion of debt. GDP, most recent measure I could find is $23 trillion. Now, how high could this go? Who knows, right? It's only a problem when it becomes a problem. Some scale, Japan sitting at 214%. They're not the shining example of an economy, but they're still there. It's 214%. UK is at 100. Germany is at 60. So it gives you kind of some scale. The largest economy in the world is sitting at 120% of debt. I think the real point here is part of the growth we experienced in the economy was the borrowing and deficit spending that drove this up, fueled by cheaper interest rates. The question is, if interest rates stay up, what happens to the economy, and can this be repeated? So let's take a look at interest expense for the U.S. government. Again, quoting here some of the double line research, which I think is nice. This is a chart of the interest expense as a percentage of total tax revenue taken in by the U.S. government. Right, this little bump right here, we're sitting at 14% of all tax revenue right now will go to pay interest expense on the debt, which is an astronomical amount in my opinion. It peaked in the 80s at 18%, and it's forecast to go north to 20%. If I look at this chart here, it might be a little tough to see. This is just change year over year by sector. So Social Security spending is up, health spending is flat. Income and security is down 18%. National defense is up 11%. Medicare is up 12%. Debt interest up almost 50% year over year. Veterans are up 16%. Education is down 21%, and all others up 60%. So all of these categories are higher, with the exception of this income, security, and education. I'm sorry to see them cutting education with all the other things going on. You think they'd invest in that, but it does look like spending is continuing. Interest rates are higher. It makes me just question how much can we really fuel the economy going forward based on this deficit spending. I'll also note that I think I've been critical of Janet Yellen as the Treasury Secretary, because while she was there, she did not issue any kind of long bond for the U.S. government. When the 30-year Treasury is sitting at 0.7%. She should have, like every other American refinancing their home to lock in 30 years of low interest rates, the U.S. government did nothing of that. We should have issued a 50-year bond at 1% interest, or a 100-year bond at 1% interest to kind of save us some of this, but we did not. All of our debt is very short term, and as a result, you're seeing rapidly increasing interest rate expense as the interest rate stays high. So what are we doing about this? The deficit spending continues to grow. This is just revenue minus expenses. We spend more than we take in as the federal government. It was 1.7 trillion was the over expense in 2023. Typically, you will see an economy in good times buy down debt, actually have a negative, so surplus, a savings, and buy down debt. the good times in 2015, 2018 in here, we did not do that. We continued to deficit spend. I think that's kind of a fault. We should have been buying down some of the debt to kind of prepare for a weaker time. But that's growing. And I think what's not really taken into account is the economy. Our economy is growing in real terms. The Fed has restrictive monetary policy in place. They are tightening with higher rates, and they're pulling out money from the system, kind of reverse printing, if you will. They take it and they tear it up, they destroy the money. It removes money supply, M2 money supply from the economy. This is stimulative. So here, the federal government is actually in conflict with the monetary policy. The federal government spending money to fuel the economy. The Fed is taking money away to kind of cool the economy. And you've got kind of this battle. And it's interesting. We spent $1.7 trillion of extra cash. That's roughly 7% of our entire GDP was spent by the government last year to boost growth. And what did growth look like? Well, we grew growth. The GDP of the United States grew 3.1% in real terms, a very healthy number. That is a really, really solid number. My only caveat here is if you had to spend 1.7 trillion of extra money to get 3.1% real growth, that doesn't seem sustainable to me. That was 7% of our entire GDP was spent for 3% of economic growth. So I guess my long-winded point here is I just want to be cautious about how long we can continue to deficit spend to fuel the economy. And if that deficit is just even with budget, I think the economy would come down because it would miss that spending. So then where are we year to date? What are we doing 2024? So far, the trend line here is we are on pace. If I were to extend this out, we're on pace for 2.5 trillion in deficit spending. Again, 1.7 last year, so a continued movement. That is about 10% of the gross domestic product of the United States. So we go from 7% spending to 10% spending in 1 year. That's a big number. And so I think in the end, well, I got another slide. We'll see. So just remember that this deficit spending is stimulative, and if we have, a Congress that decides to balance the budget and spend what we take in, that's going to be extra restrictive to the economy. So what's the forecast? The gray box here. This is the CBOE, the Congress's budgetary office, saying this is what we think interest expense is going to be as a percentage of revenue. They are projecting 20% of revenue will go to interest expense by 2032. This line here, the sharp increase is kind of dramatically outperforming, if you will, that number. So we'll see what this looks like. I'm not sure this is sustainable. I have no idea when it might be fixed, but I think there is some kind of fix that's going to have to happen, and what that cost, I'm not sure, but just keep in mind, it's kind of good macro data of how we grew the last 30 years. Deficit spending, lower interest rates. Interest rates come up now. Can we continue that? Probably not. We need to find investments that can still have pricing power, that can still operate, gain market share in a landscape that does not have that stimulative federal funding that comes out with renewed and continued deficit spending. So what's one of the biggest sectors that's been affected recently? It's in the headline news. I hinted at earlier, the commercial real estate problem. So what's going on, right? These real estate in general is a massive leverage bet. U.S. Retail people put very little down on a home. They finance it, the whole thing. Same thing with the commercial market. So the breakdown in the total market value of commercial real estate, at least this estimate, was about $5.8 trillion of outstanding CRE debt is out there. We're seeing some delinquencies move up sharply since the rate rise, right? We're now at about $17 billion of losses, or delinquencies rather, for the non-owner occupied properties. As that trends up, that's going to be a bit of a problem. So how big then is, if the commercial real estate market is 5.8 trillion? These numbers are just so big, it's hard to understand its actual impact to the economy. So I tried to scale it for us a little bit. So I said, okay, how big was the great financial crisis? Like, that's the biggest thing that I think in anyone's memory. How big was it? Well, that the great financial crisis, this is a Google search, resulted in $2 trillion of a loss. Okay, well, we've got a commercial real estate market here that's 5.8 trillion in total. So if you wrote down half the business, that would be equal to roughly the great financial crisis in size. So then here's an outlook. Then the outlook for the sector is now so bleak that Cantor Fitzgerald's billionaire chairman and CEO Howard Lutnick is predicting between $700 billion and $1 trillion of defaults over the next 2 years, unless interest rates fall quickly. And he sees that as unlikely. So as he continues, I think we're going to have a very, very ugly market in owning real estate over the next 18 months or 2 years. This is going to be a generational change in real estate, to the point there's an estimated 1.2 trillion of commercial real estate debt maturing in 2025, according to the Mortgage Bankers Association. That's 25% of the debt is in the hands of struggling offices and retail spaces. With interest rates rising more than 5 percentage points in the past 2 years, that's a recipe for default. So back to this debate over how long interest rates stay where they are. The longer they stay here, the more likely something like this happens. So it's kind of like bad news is good news. If this happens, interest rates come down, it prevents the further decaying of these upside down properties, because they're able to refinance themselves at hopefully a rate that cash flows. So I think this is a problem. Its scale is really large. Here's another quote. Just looking at the commercial real estate, it's about $1.2 trillion of the U.S. commercial real estate debt was potentially troubled, quote unquote. So that's half the size of the great financial crisis. And Cantor Fitzgerald, for those who don't know, is a massive brokerage company that specializes in commercial real estate. Is this going to happen? No idea, right? Nobody can know what the future is, and this is a kind of multifaceted system where actors can make changes to affect this. So if we cut interest rates, this goes away. The thinking there is perhaps that reignites inflation. So it's kind of a balance between the two, and we'll see what happens. I wanted to recycle this quote from the last meeting. I still think it's true. It's, we're going to have a debt crisis in this country. How fast it transpires, I think it's going to be a function of the supply and demand issues. So I'm watching it very closely. This is Ray Dalio, right? He runs one of the biggest hedge funds in the world, Bridgewater. He's all over the internet, and I think he's right here. I think nobody knows when this is going to happen, but we have to do something at some point. So in this landscape, we then kind of diverge into what stocks might be of interest. How do we navigate this macroeconomic environment? So where are we? Here's a clip from Fidelity as they look at the business cycle, and they're trying to identify where are we in this great cycle of ours. Historically, at least the last 20 years, the Fed has mainly printed money or engaged in quantitative easing to lower the recession here, this part. If you go back, and I'll just detour here quickly. If you go back in time before the Fed started doing this, and you look at the gross domestic product movement, where was that chart? Here. You can see before they started printing money, the swings up and down were much more volatile. This is the business cycle people would talk about. Things would heat up, things would get speculative, it'd crash, the market would fall, and you have much wider swings. But conversely, when it comes down, you upsize much bigger. And a lot of young people took advantage of this coming out of school. The market crashes, you're able to get into to stocks cheaply, you're able to buy homes cheaply, and it rips higher. And the spread there was much, much higher. But of course, nobody likes that when it crashes. So the Fed started it with Greenspan, really started manipulating how much influence they have over the economy. And they've done largely a very good job. Look at the dispersion here. Now, economic growth is much tighter. It does not, we don't allow it to run high. And conversely, if there's any kind of blip in the downside, we cut off the downside, which is nice, but that doesn't give an opportunity for people to buy really discounted, really deeply discounted real estate, stocks, bonds, all that stuff. It really cuts out a lot of the volatility as the Fed steps in and saves us kind of every time from the real downside. So I only say that because if we're looking at this like downside here, I think right now the stock market is kind of looking through this. They're saying, hey, if it goes down, Fed cuts the rate instantly, the market economy rebounds. So there's probably 6 months here of issues. So let's go ahead and just buy the stocks now. And that's what we experienced in Q4. Was everyone saying we're going to have one, we're just going to look right through it. And Fidelity is saying that we're kind of on the cusp of some kind of recession. I think the trick here is how much can they actually do? They can't cut rates to zero. We would have inflation again. So we'll see how they transpire. No one's really sure, but I think we are on some sort of edge of something. So what happened last year? What performed well? So what performed well is equities did extremely well as people looked through the coming recession, or in theory a recession could be coming. They said, well, if I hang on to it for 6 months, ride it through, the Fed saves their day, then the Dow Jones, S&P 500, the NASDAQ up 40%. These things were all driven by some of it was AI bubble, but the next of it is just looking through and believing the Fed is going to save us, that this bad news is good news idea. If the economy comes down, rates come down, life returns to normal. That's what the market is betting on. So I like this chart from Morgan Stanley. It gives you a real long-term view of what the stock market has done in here, and I highly recommend you take some time. I'll post this in the Cash Flow Club. Go back through or take a screen grab and look at it at your leisure. But it has some great information here. It tells you about market multiples. So it's showing up top. Here's the S&P 500 index level. Here's the ratio of price earnings ratio of 25 times, 15, 19, 21, and 19.5, and the earnings that kind of equivalent earnings from 2000 to 2023. This 60 to 245 is a 6.3% annual growth in earnings. That has really underpinned the S&P 500 movement, and these swings you see up down is kind of the combination of earnings growth and deceleration, and then market multiple expansion and contraction. So if you look at this period here, this first period in the 2000s, this was kind of the multiple collapse from the peak here down, this drop of 49%. That's because the market multiple on the S&P went from 25 times to 16 times. So now almost a halving of the multiple. Earnings themselves didn't fall all that much. And then from here, this 100% return, this rip here, was mainly pure earnings per share growth. The market multiple didn't move a lot at all. 15.9 times down here, 15.1 up here. So this is all just the .com, the Microsoftization of the office landscape, where people continue to just use technology and grow earnings. That was 100% return. And then the collapse here, right? That was market multiples went down, earnings went down. That was the great financial crisis. Both collapsed, and you dropped 60%. From that bottom, that 400% rise, this is lots of stimulus, earnings per share growth plus market multiple expansion from a low of 10 to a high of 19. So you get a doubling. And I think a lot of what we perceive as the stock market, a lot of what we perceive as how to invest is framed by our recent memory of the stock market. And we forget that the market can go sideways for a long time. And when we think back of this great run from 08 even to present day, as this kind of continues, this rapid growth is a reflection of earnings growth, right? Standard earnings growth, and a massive market multiple expansion from 10 to we're now at 20, so a doubling. So half of the outperformance of the S&P 500 over the last 10 years has been simply the multiple expanding from 10 to 20. So going forward, is it reasonable to assume that the market multiple is going to expand from 20 to 40 and do it again? Probably not. It's probably going to stay where it is or contract. That means that stock performance is going to be based primarily on earnings growth, not the market multiple expansion, albeit a few stocks here or there that you might be able to pick off. So where are we then in terms of the distribution of market multiples? What does it look like? I show this chart at every cash flow webinar. This is the 30-year standard deviation of the earnings multiple. And you've got kind of like a box grid up here that shows various different valuation metrics: PE, CAPE, dividend yield, price to book. All of these at the latest measure are above their 30-year average. So we are saying, hey, we're at the kind of one standard deviation away from the mean. We tend not to hang around the two standard deviation too much. This year here is about 4 years, from 97 to 99, a very crazy time. I remember that time, and a lot of what I see in the AI space and the EV spaces is reminiscent of that. Just go by almost anything, it all seems to go up. We're still sitting about 20 times. I think that's a high. This is driven mostly by the top seven stocks in the stock market. Most of this, right, is being borne by the Nvidias of the world, the Amazons, the Apples, the Googles, the Facebooks, right? This index is a market weight index. So the greater the market cap, the more money gets put into the market cap by the S&P 500. It is not an equal weighted index where it says I have 500 stocks, I have $500, I'll sprinkle $1 into all the stocks. That's not how this works. The S&P 500 is a market weighted index, meaning I have $500, rank them as a percentage of market from biggest to smallest, and match that weighting with their size. So Apple's, Google's get the lion's share of the money. Those trade at a higher multiple. That's why this multiple is higher. One thing to note, I can't get into it too much, but I think it's interesting, just the international valuation. So while the U.S. has continued to rip higher, the international stocks have not done well relative. And the price earnings ratio, well, we're sitting at a one standard deviation above the 30-year average. These guys are 2 standard deviations below the average. So there might be some kind of value out there that you need to look at as you're kind of shifting around and looking around the world where to put capital. I think the U.S. is definitely a crowded space. It was just another way to slice the S&P 500. So I was talking about weighted average versus equal weight, right? So this is just saying the weight of the top 10 stocks in the S&P 500 is 30%. So 10 stocks make up 30% of the value of the entire index. Obviously, they're going to be driven like that. The rest of the stocks that are not those 10, their performance is here. So this blue line is the rest of the market. This top line is just the top 10 stocks, 60% of the gains since 2023. And so I think the question is how long can that really run? That's going to be a question. We've had this in the past. We've had the .com, we've had the Nifty 50, right? Everyone says Like the mantra back in the 1950s was nobody gets fired buying IBM. That was true. You just, every fund manager had to own it. If you didn't own it and it outperformed, you were fired. If you owned it and it went down, you kept your job because, well, everybody's invested in it. So we have the same thing here. Everyone is in the same pool, and so what happens if the pool is no longer performing as it should? I don't know how pools perform. That's not the best analogy, but I hope you get my drift. So let's take a look at just a different sector entirely. Right, we're cash flow hungry. Let's take a look off the beaten path. Anybody can take a look at Apple and tell you what you think it's the value is. There's a billion people that are doing that. What is the Russell 2000 doing? Let's go down. What are the smaller stocks doing? It's pretty interesting. This chart just shows the number of the percentage of the unprofitable companies in the Russell 2000 is sitting at 40%. That's astounding to me. If we rewind the clock a little bit and we say, okay, what was it in 2010? 2010, it was, I call it, so 2000, it was roughly 25% of the index. Okay, well, what was interest rates? How much was 30-year bond at that point? Well, that was 6% interest. If interest rates are 6%, right? Because these companies have to fund their losses somewhere. They fund it through equity capital or they fund it through debt. You can only print stock for so long. You can only borrow for so much. But as interest rates fell, companies were able to refinance their debt, free up, unlock more cash flow. That cash flow was used to fund losses, and they continued moving on. Here in 2000, 6%. Fast forward 10 years, the long bond was 4% interest, and we moved from basically 25% to 30%. Fast forward to the peak, the absolute peak of the losses, 50%, over half of the Russell was operating a loss. That was a low point of the 30-year at 0.07%. And now this has come down as interest rates have gone up. We're sitting at 4.2% is the current rate, and you have 41%. So this, what I'm trying to say here, and I'm long-winded, apologize, is just that the interest rates affect how long unprofitable businesses can remain solvent. And if rates stay here, then at 4.2%, this percentage here should fall, and you should see about another 10% of the Russell 200 enter some kind of restructuring phase, go bankrupt, because at 4.2% with the 30 years is currently, they should be sitting at about 30% of the Russell should be unprofitable, not 41%. So that means that we have to be very careful when we're looking at companies that are small, or any company, right? But just this particular sector. There's a lot of garbage in there, and you have to sift through a lot to find anything that's decent. I saw this on the internet, so I thought I'd steal it. Nvidia laid on top of Cisco in the 1990s. So this is, the first boom here was just the semiconductor, the gaming boom, the Bitcoin craze. I have to have, this is the only processor I have. It's going to the moon. And then, oh, Bitcoin crashes. Oh my God, it's down 50%. And then, hey, here's a new theme, AI. Oh, that's clearly going to go to the moon. And then boom, it just absolutely blows up. The stock is even higher than this now. This is an old chart. This is only $471. But it's going to come down. It's just a question of when. And I just would hate to own it when it falls, because everybody rushing to the door, you are not going to be the first out of the gate. None of us are sitting in front of our terminal all the time. Hopefully not, if you're a value investor, right? None of us have the connections to Wall Street to be able to front run people or to get the smell the panic happening. A lot of the retail people get hole in the bag because we have 9-to-5 jobs. We don't get the reports till next week, or kind of get around to it, and by then the stock is created. So I'd be very careful with speculative stocks like this. I thought it was brilliant that Tesla had their earnings announcement the other day, and people They missed growth. And Musk's comment to that was that they are, quote, between growth waves, which I thought was the most hilarious way to say that the stock was down, or the earnings are down. And we're not down. We're between growth cycles or growth waves, which please, that's, if I could make a bumper sticker to that, that's fantastic. The man is very talented, and he says what's on his mind. It's good for him, I guess. So where's all this money going? So what are people doing with their cash? Well, they're sitting in cash. $6 trillion are in money market funds that continues to grow as interest rates stay up there. You're getting paid to wait. I got a ping. The Apple credit card right now is paying 4.2%, something like that, for having an Apple credit card. That's amazing. And Apple is reacting to interest rates faster than traditional banks. A lot of the biggest problem here is banks are trying to create earnings. The bank's earning is the spread in interest between what they can borrow and what they have to pay out for. They can borrow now at a higher rate, or they're getting money on a higher rate, 4.2%, and they're paying us for our savings accounts next to nothing still. That's how banks' earnings are growing, is they're just holding our consumer back. Apple and others whose business is not banking are doing customers a service by pegging their returns much more directly to money market funds, and they're helping customers out. I really like that, and it's driving money outside of banks. It could be a problem for just the capital ratios of the banking sector, specifically the small regional banks who did a lot of the commercial real estate underwriting. They're going to have a major problem. So this cash sitting here, it's got to find a home at some point. It'll either continue to stay there. I think it might go into the bond market once the bond market sort of solidifies it at what rates might be. Does it go into the stock market? I'm not sure. Just sprinkling an interesting chart in that I saw. This is the U.S. population growth. I thought this was really interesting. Just the year-over-year change, and how it's near zero. I would not have guessed that. But the natural birth rate of the United States is dropping a lot. I think that's part of the reason we're seeing the U.S. government allow a lot of illegal immigration come in, is they need to expand the labor force to continue to grow the economy. If you break out the GDP function, the equation that equates to GDP, labor is a big piece of labor. Consumption, net exports, and investments are the four components. The labor piece for us does two things. It combats this, which is deflationary. If population declines, it's deflationary. Everything comes down. That's a huge problem when debt is continuing to grow up. You can't have the economy declining and debt growing. That's the fastest way to bankruptcy. So to combat the low birth rate, this is just me speculating. I think they're just saying, hey, we need labor force. So you're getting a lot of working age males coming into the United States. And that for them is going to prop up the labor market, expand GDP, and to take off pressure from wages, because you have a greater supply of working age people. So I think that's why we're seeing this issue happen at the border, as people, as politicians look at this data and figure, how do we continue to grow the economy? That's just one way to grow it. Good or bad, I'm not passing judgment. I'm just saying technically that's how you can grow it. Let's take a look at the mortgage market before we get into kind of some specific stocks. 23-year low home sales as mortgage rates touch off new recent highs. So as I said at the outset, real estate is a leveraged bet, and most everybody buys a home with leverage, and the home price, the price at which you pay for the house, is established by how much you can afford on a monthly payment. That monthly payment is determined by the interest expense or interest rate on that mortgage. So no surprise, mortgage rates go up only slightly. This is a 4% increase, right? That's not that big, a 4% move, and it absolutely just devastates demand for housing. So we'll see. The question here in housing is, does it stay up here? Are we staying elevated for a period of time like this? If we stay elevated up here, then demand for housing will continue to be at an all-time low. If they cut rates because the economy comes down, then it gets cheaper. But then if people don't have jobs, they don't buy houses. So I think this one is still it can go lots of different ways, but it's a very interesting a couple different changes to the real estate market. All right. So as I was saying earlier, we've got, with all of the things going on, I think the world is starting to reprice growth. And I've got a couple charts here just quickly, some stocks that I thought were interesting that are reacting to as they can't grow as fast as expectation. Tesla has been a big darling of this for a long time. People debate, is it a car company? Is it a technology company? I think everybody has their opinion on that. But at the end of the day, they actually have to manufacture the car. They can't just put them in cyberspace, at least not yet. So as a result, you have labor, you have people, you have manufacturing, you have costs. And as they underperform, the market multiple that they trade at is hurting their stock price a lot. And so that's just the market reacting to weaker than expected growth. JD.com, the Chinese market is absolutely been destroyed. It continues to be destroyed. That's one of the reasons the Beijing has banned short selling. I mean, nothing says free market economy like banning people from selling the investment. So that's a great sign for the Chinese stock market. So be very careful with this. I get it. You look at the numbers as a value investor. I do it the same. Baba, David and I were just talking about the other day. I think the market cap is the EV of Baba is $5 billion. They have more cash than that on their balance sheet. Like it's crazy cheap. But the problem is twofold. One, the reason you do that number is if the company goes bankrupt, what do you get to keep? The Chinese government would never let you take the money out of China. So I think that's an issue. And then two, the financials you're staring at, how do you know they're right if the auditors are not in there to really validate what you're looking at? We're all trusting this because we're used to the SEC overseeing all the numbers that are on the reporting, but the Chinese are not allowing the auditors to audit those numbers to the extent that we would here in the States. And I'm not sure that the data you're looking at is accurate. So for me, I think that's a no for the whole region. I'd be very careful about that. There is I think his name is Kyle Bass. He's a hedge fund manager in Texas. He tracks a lot of what the Chinese do. He's been really outspoken about that. And he says, I'm paraphrasing here, that the Chinese have stopped delivering a lot of the economic data that they used to because the data was negative. They have then moved that department inside the Chinese wall. And so now the government actually releases what the economic data is. And so in his opinion, it's largely tainted and can't really be trusted. So I would be very cautious about just assuming those numbers are right. Este Lauder, they have a lot of stocks in a lot of their sales come from the travel sector and a lot from the Chinese market that was down. Stocks absolutely been hammered down almost 50% since its high. I actually like this company. I owned it at a period of time when it was running up and I thought it was overvalued and sold it. But it has a global footprint, a very sticky product. I think the more people engage in conversations like this and webcasting, makeup usage is going to go up. So I do like the company. The question is, what is the right multiple for this to get back into this company? But the point here is just the market repricing growth as people miss. The downside to missing is really high because the market multiple is high. If you're sitting at a 20 times earnings multiple and you miss earnings, the stock's going to go down twice as much had the stock been at a 10 times earning. Advanced Auto Parts, they recently changed CFOs, CEOs, and put in a new chief accounting officer because of some accounting problems and earnings problems. So that stock has absolutely been crushed in a sector that is growing. I think that the used car market will continue to be a strong market. These companies, along with O'Reilly's, and I'm blanking on the others at the time, but there's several of them. They all supply used parts into refurbishing cars and updating. Even if you're going to go to EV fleet, I still think you're going to be wanting to change parts. You're just changing EV parts. So I really do like this sector. By the way, I just saw a bill that came to light in California. You guys aren't in California, but for those that are, they want to by 2028 have an electronic switch in all cars in California that cap speed at 80 miles an hour. So for all new car sales. So no matter if you were buying your Ferrari, I don't care, it's capped out at 80 miles an hour. That type of legislation might actually make keeping old cars around a lot longer, much more useful. And these guys actually had a growth in revenue last quarter despite all the internal muckery. So I think that's interesting. Peloton, just kind of reminding people that euphoria can be dangerous. These guys squandered cash like crazy, and just really destroyed what was a very, very brilliant business model with crappy leadership. Smile Direct Club, same kind of thing. Just absolute euphoric, very interesting idea to help people fix their teeth via mail. I kind of like that idea, but the valuation was nuts when it went out. So this is back to my thing about IPOing and bankers. When they are doing a roadshow, there is just so much money that they can't help themselves but agree with management on rosy projections and the best case scenario, because they all get paid a tremendous amount of money for a successful IPO. And all they need to do is just have it last a good 6 months after the IPO sale to make a killing. All this here, you think any of those guys had any of this stock? No, it was all gone. So when you see a presentation by a company, the investor relations department, when you see a presentation by a big bank that is an underwriter, those guys want the business for the companies. They very rarely will issue sell ratings from their analysts. They would rather drop coverage from a stock entirely than issue a sell rating, because at some point that company's going to want to raise capital. And if Morgan Stanley's analyst is always having a sell rating on it, they're not going to pick Morgan Stanley as book runner. That's just the way it is. So, you do your own research, come up with your own opinions. I think you guys are smart enough to kind of, you're going to win some, you're going to lose some, but at least they're your decisions, right? I mean, so all right, let's recap a little bit of what we did, how we did last quarter when we looked in October. So what did we recommend? A United Health Group. We like the healthcare sector. We picked that one. That one's at a pretty steep multiple. This is as of October 6th versus Jan's 26th. So it's down 3.8%, but still very, very healthy company. Long term, it's great. RTX, that's Raytheon Technologies, right? The combination of Raytheon Corporation and United Technologies, an absolute powerhouse in satellites, in defense, and a lot of synergies there. We picked that company up at $70. It's now 90. It's a 30% gain. That was a great little call out last quarter. Google, we thought was cheap. Picked up 10.6% there. Target got absolutely destroyed with some of the looting that was going on. And they missed earnings and was absolutely punished. We picked that stock up and made 37% growth in a quarter on Target, which, like, people fall asleep when you say Target. So that's really, really interesting. Great call by the group. And Applied Materials, 19% up since we called it last time. CVS has not done as well as we had hoped. It's up 6%. I think a lot of the thievery that's going on in various states is really, really hammering their retail market. But long term, they are moving into the healthcare business, so they should eventually get a higher market multiple. That's the theory, and be more like United Health Group. But we did really well, and to kind of frame this, so as a whole, combining all those picks that we said, assuming equal weighting, we got 16.7% in a quarter for the growth there. The S&P 500 did 13.9 for the quarter, and the Nasdaq did 16.5. So we beat S&P 500 and the Cube. and the triple Q. And so what I'll leave you guys with before we get into the actual stock picks for this quarter, I want to leave you with a couple parting words here. Mark Twain, this is a favorite quote that Howard Marks talks about a lot, who runs Oaktree. If you guys aren't following and reading his newsletters or listening to his podcast, there's a podcast for Oaktree. I highly recommend you listen to it. It's phenomenal advice by a man who's been investing for 50 years. So it says, it ain't what you don't know that gets you in trouble. It's what you know for sure that just ain't so. And that's Mark Twain. That is so true. All of this front stuff that we talked about at the economy is great stuff. I don't know what that means for tomorrow. So, try and humble yourself. We're going to win some, you're going to lose some. But remember that betting on what you think for sure is the best way to fail. And then I like this quote, to make money in the stocks, you have to have the vision to see them, the courage to buy them, and the patience to hold them. That's George F. Baker. He's from 1840 to 1931. At the time of his death, he was the third richest man in the United States, behind Ford and Rockefeller. George Baker, railroad and banking was his industry. So, all right, thanks. That's the main presentation here. We'll dive in now to the stocks to review in the cash flow club for next quarter.